Good afternoon, everybody. Uneducated economist. So this is going to be part two of the monetary policy strategies for a low neutral interest rate world. And this is part two of probably what's going to be maybe about a 4 or 5 part series. And it's a speech that came out of the Federal Reserve Bank on November 30th, given by John C. Williams. And if you haven't seen part one yet, you might want to go check out part one. It might make the rest of this seem a little more relevant. But even if you haven't watched part one yet, there's still a lot of good information in here. So let's go with it. As a starting point, it is useful to travel back in time to the 1980s and 1990s when inflation targeting was introduced. The problem at the time was high variable inflation that contributed to macroeconomic instability and unmourned inflation expectations, which in turn fueled high and variable inflation. To break this vicious cycle, numerous central banks instituted inflation targeting and variants thereof, with a focus on bringing inflation down to a low level and fostering the establishment of stable, well-anchored inflation expectations. This strategy worked extraordinarily well in the decade preceding the global financial crisis, as central banks were able to achieve remarkably low and stable inflation, leading to the positive feedback loop between low inflation and well-anchored inflation expectations. Today we face an altogether different set of problems stemming from a very low neutral interest rate, that is, the short-term real interest rates consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. So let's break this down a little bit, right back to the very beginning of the paragraph here. It says, you have to travel back to the 1980s and 1990s when inflation targeting was introduced. And so the problem at the time is what he says here, was that they had high and variable inflation that contributed to macroeconomic instability and unmourned inflation expectations. So basically what he was saying is that all these central banks around the world weren't really on the same page when it came to inflation, and some of them were just causing really crazy inflation, and other ones were trying to remain stable, and it was just this kind of chaotic thing happening back then. So what they did is they were able to get all the central banks to kind of line up together and do a targeting inflation expectation. So they didn't have like these wild inflationary swings. They were trying to maintain a consistent inflation. And he says that's what what is he? It goes on to, the strategy worked extraordinarily well in the decade preceding the global financial crisis, as central banks were able to retrieve remarkably low and stable inflation. Now, it worked really well up until the financial crisis because they had interest rates fairly high, right? And now, I guess what I mean by that is that back in like the 80s, they had interest rates like really up there, pretty high. Like, to kind of put that in comparison, a 10-year treasury right now has like a 3% yield to it. Well, back in the 80s, it was like 15%. So you can see how much higher the interest rates were back in the 80s than they are compared to today. And when those interest rates are that high, they give them a lot of room to move. So like as, recessions were kicking in or economic downturns were appearing, you could drop interest rates down, stimulating the economy, because now some people were able to take out loans at a cheaper rate so they could buy houses and cars and take out credit card debt and all that other stuff. Right? And that's why he was saying that's, the system worked extraordinarily well in the decade preceding the global financial crisis, as central banks were able to achieve remarkably low and stable inflation, leading to a positive feedback loop between low inflation and well-anchored inflation expectations, right? So they wanted inflation very low. They were able to do that consistently, and, and that's where they were saying that, hey, everything was cool back then. Today, we face an altogether different set of problems. And this is probably the most telling part of the whole thing, because it's actual fact, right? It's not his opinion or anything. He is stating here, we face an altogether different set of problems stemming from a very low and neutral interest rate, that is, the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. So what he's basically meaning by that is that, and if you're not quite sure what the neutral interest rate is, go back and watch my autopilot video, and it really kind of breaks it down. But what neutral rate is that what the Fed wants to do is they want to try and get the Fed fund rate to neutral. And what that means is comparing it to growth. So if the neutral rate is right at growth, the Fed would neither be nor restrictive nor accommodative to the economy. It's neutral. It's right in the middle there, right? And so up until like basically just recently, they've had interest rates incredibly low, like near zero, right? And they just started incrementally kind of kicking it up, doing 0.25% every quarter until they've gotten to this point, right? And now 3 months or 2 months ago, Powell said, we are a long ways from neutral rate. And then just the other day, just before this speech came out, he said we're approaching neutral. Well, they didn't raise rates. Neutral came to them, right? So that's the growth dropping, and that's basically what he said there. We are facing a set of problems stemming from low neutral interest rates, right? That growth is so low, and the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. So what he's saying is that, yeah, the economy is rolling, but interest rates are so low, and we can't really kick the interest rates up, because if we do, we're going to run into this neutral rate or even exceed it. So there's the problem. This is where the problem lies, right? And he goes on to say, ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high, right? So when when they started raising interest rates and the Dow started coming down and the housing market started coming down, and they realized, hey, this economy is kind of going, kind of not doing so well when we raise these interest rates, they're saying, well, we really don't have any room to drop them to stimulate the economy again, because as we try to kick this inflation off by lowering interest rates, there's nowhere to go. All right, that was part 2. Come back for part 3. Thank you guys very much.